Good afternoon. Happy Friday. This is Sean LaBelle of the Dekker Hewett Group. North American markets sold off pretty aggressively here this week as we started to get an indication on Monday that the U.S. Federal Reserve would be increasing their interest rates at around 75 basis points. The markets had already priced in a 50 basis point rate hike. So that news spooked markets a little bit. Obviously, this is a result of the inflation data that we saw last Friday, which continues to show that inflation is stubbornly high. Of course, on Wednesday, we did get the U.S. Federal Reserve hiking their overnight interest rate 75 basis points, now in a range of around 1.5 to 1.75%. We did get a nice little rally on Wednesday, but the market sold off pretty aggressively on Thursday as investors started to understand what this would mean for the balance of the year. Because looking towards their dot plots, this is the forward indication of what they expect to do for the balance of the year with respect to those interest rates. Their year-end target now for the overnight interest rate is at around 3.4%. This was coming in at around 2% when we started the year. So you can see where we were and where we've gone in terms of what we're going to get for those interest rate hikes. So this means that market participants should expect another 150 basis points in hikes for the balance of the year. That means that we'll likely see another 75 basis points in July and then probably a couple quarter points for the balance of the year. But more interestingly is the dot plot for next year in 2023. We're really getting to that neutral rate, which is around 2.5%, as fast as possible. The dot plot would indicate that next year we're only going to see one or two interest rate hikes. So what the Federal Reserve is doing is just getting back to a sort of stable monetary position as opposed to one that right now is still quite accommodative, right? If interest rates are around 1.5%, but the neutral rate is 2.5%, they're still actually stimulating an already hot economy. Hence, this is why the U.S. Federal Reserve is increasing their interest rates at probably a faster pace than a lot of people are accustomed to. So we don't really talk about that a lot in this week's Market Watch Weekly. It does dive into the inflation conversation a little bit, but it more so just looks at the historical corrections that we've had before and what the forward 12-month returns are for the market. As we've been telling you guys for the past few months, you want to stay invested. Timing the market is a terrible choice and a very, very bad investment strategy generally. And again, there's just another interesting table in there to remind investors. You miss out on the single best day in the last 20 years. Your annualized return goes from 9.9% down to 6%. That is a considerable drop for just missing one day. You miss out on the 20 best days in the year and your annualized return goes from 9.9% all the way down to negative 24%. So timing the market is definitely a dangerous game. It's not something that we suggest. And there's just some added commentary about that in this week's Market Watch Weekly. We'll end it there. Hope everyone enjoys the weekend. Happy Father's Day to all the dads out there. We will talk to you again next week. Cheers.